Jing Ulrich in Sydney. She's chairman of global markets at JPMorgan Chase. Great to see you, Jing. Just tell us, the challenge is going forward, isn't it? What happens next? Because now we know that we are seeing a serious slowdown in the developed markets. So are these kind of trade surplus figures sustainable?
Absolutely. I think going forward, we need to monitor the Chinese export situation very closely. China is the single largest exporter in the world. It exports about $1.6 trillion of goods every year. And Europe is the single biggest market for China, about 22% of all Chinese exports. The U.S. is also important, accounting for about 18% of Chinese exports. Now, importantly, we need to keep in mind that emerging markets have become much more important in the last 10 years, having doubled the share of Chinese exports from 10% to 20%. So we need to monitor the Chinese export situation because it is still a very important part of Chinese GDP.
Do you expect exports to slow?
Yes, we do. We have seen the export momentum slowing already in the last 6 to 9 months of the year. Going forward, I think given the situation in Europe and the U.S., given fiscal tightening across the major developed economies, Chinese exports will probably slow going forward. Now, importantly, emerging markets such as India, such as Brazil and Russia are taking a larger share of Chinese exports. The challenge for the Chinese leadership today is to try and develop the domestic economy so that the country is becoming less and less dependent on exports, but much more reliant on domestic consumption for future growth.
What does it mean in terms of the Chinese government's policy reaction? Are we indeed going to see them pause on tightening measures? If so, for how long? And could we even possibly see, should exports significantly drop, some more stimulus, some fiscal stimulus from the Chinese government?
We would expect the Chinese government to pause on its tightening policy. In the last year and a half, we've had a successive host of measures introduced by the Chinese leadership to tighten control on monetary policy, on housing, etc. Now that inflation may have peaked last month, we think the Chinese government will be selectively easing policy in the second half of 2011. However, we do not expect to see a large-scale fiscal program. Frankly, we're still trying to deal with the aftermath of the last fiscal stimulus program in the form of potentially higher non-performing loans. I think what China needs to do is to redirect some of the fiscal resources towards areas such as low-cost housing instead of introducing a large fiscal stimulus yet again at this juncture.
So given the backdrop of all of this, we know that the Shanghai market is now in bear territory. Is this a good opportunity for investors to buy some Chinese stocks? And if so, in what sectors?
Well, for longer-term investors, if you have a 2 to 3 year time horizon, you may want to consider buying some stocks in Hong Kong and maybe even in mainland China. But remember, investors can get exposure to China through a variety of stocks listed outside of China. For example, in Australia, where I am today, a lot of the resource companies have huge exposure to China, to China's ongoing infrastructure program. In Europe, you have the luxury goods retailers in China doing very, very well. You also have some of the large automakers in Germany and other countries in Europe which have benefited from the tremendous surge in demand. So you can think about purchasing stocks in China. However, you need to think about some of the China proxies as well, listed in Australia, in Latin America, and in Europe.
All right, Jing Ulrich there from JPMorgan Chase.